So,
yeah, reporting.
Yeah, okay. So he is going to retire. So we're just taking, let's say, a retirement. When he's going to retire when he completes his 30-year service. And what we have to find out is what is his past service liability he has accrued till date. So he's accrued 10 years worth of thing. And we are looking at a particular financial, which is the last 1 year. So he's put in 1 year extra service for which he's going to get 1 year extra retirement benefit at some point in time. So the benefit is payable 20 years from today. So what actuaries essentially do is find a present value of that from there till here. Is it simply just a discounted value? No, because the chances are that this guy could leave and go in between. He could, die in between. So it brings in those attritions as well while he's serving these 30 years of service. So this is again in, I think, accounting parlance, you called it matching principle. So इस साल का सर्विस डाला था, इस साल का बेनिफिट उसका कितना है? Again, very quick background on what Payment of Gratuity Act says. Anybody above 10 employees is due for gratuity, has to be paid on death, disability or resignation, and of course retirement. There is a 5 years of vesting period required in case of resignation and retirement, which means if somebody were to die in the second year or the first year, he is due for gratuity benefit. I mean, as an employer, you have to pay him gratuity benefit. So for death and disability, there is no vesting period. Because a lot of times people say my company is only 3 years old, 2 years old. I'm probably not having, because I have to pay only when they complete 5 years term. No, that's not the case. And of course, the matching principle doesn't allow you to wait till 5 years because you're actually accruing the benefits. The Act actually gives you the formula for the benefit, that is 15 half a month salary for each year of service. But the Act also says that this is the minimum. So there are many employers who pay more than this. Okay. Leave essentially covered by Shops and Establishments Act, and there are many types of leave, casual leave, sick leave, and all that. What you need to look for is whether it is accumulatable or encashable. Okay, these are two important things that one need to look for. And there are no defined formulas. It's as per the company's policy. So you have to look out for if the company is changing the policy, if the company has, because, Corona comes, Corona goes, so something happens, companies do tend to change their leave policy quite quickly. And as auditors, as actuaries, you have to look out for these policy changes. See, Gratuity Act doesn't change so frequently, but the company's leave policy can change quite frequently. So this is something you have to be looking out for. Okay, so we have a poll question, which essentially is that other than gratuity and leave encashment, what are the benefits you think would require actuarial valuation? If you could just quickly type your answer. It just gives me a 2-minute break. Yeah, no, I'll set up a little while. Yeah, 4 people have answered. Yeah, 6, 8. We'll just wait for a minute more. Great. Yeah, it's all the above. So all of these benefits attract, so there is an uncertainty to the cost. So hence there is a requirement for estimation. Okay, so let's get down to the actuarial process. So this is where really my job begins. So let's understand what does an actuary do when he's saying that I'm doing actuarial valuation. So I'm dividing it into very simple 4 steps. There are a lot, the devil is in the detail, as they say. I'm not getting into those details, but this is just to give you a big picture. First is data collection. So what do you collect in data? Employee-wise, date of birth, date of joining, their salary details. The scheme details, which is, what is your gratuity benefit? Is it as per Act or is it more than Act? Or what is your leave policy and things like that? Then is fund requirement. So which is, do you have assets backing these liabilities? So have you purchased an LIC gratuity policy? Have you purchased a leave policy? Or is it unfunded? So we ask for the fund statements of LIC's thing. So that's on the fund side. So these are typically 3-4 data that we collect. And honestly speaking, as actuaries, we have no access to verifying these informations. So if he gives me, he's got 50 employees and these are the salaries, I have to believe because I have no other access. And this is where probably auditors come into play. So I will kind of get into more detail on where actually the auditors play an important role in this. But this is one point you should keep in mind. So once we collect all the data, we have to set critical assumptions. So there are mainly 3 very important assumptions, and I'll get into the detail on how we determine these assumptions in the next slide. But what you need to know is discount rate, salary escalation, which is the increase of salary per annum, and the attrition rate is 3 most important things that go into it. Okay, there is mortality rate and other things as well, but those fairly standard. So there's less debate happening between professionals or the company and the actuary on these. Then the actuaries go back and do what's called a cash flow projection. So essentially, in simple terms, what do? We project every employee, every single employee till his retirement. And I actually say, okay, if he were to resign next year, what will happen? If he were to resign the following year, what will happen? If he were to resign in the 4th year, what will happen? So I have probabilities for when he will resign, when he could die, okay, and when his retirement is. So I kind of project every single employee and their expected benefits at those points in time. And then we take the present value of those, and that's what constitutes. And then I aggregate it for all the employees. So that's, in a simple terms, that's exactly what I do in cash flow projections. Then we produce the report. Once the basic cash flows are produced and estimates are arrived at, we share the draft numbers with the company or the auditors. And once we have discussion about whether the assumptions are appropriate, we need to change the assumptions, we finalize and we give the report. The reason the report is another step is because, see, in AS has different disclosure requirements, AS 15 has different disclosure requirements. So based on, and if the company has a US parent, then the same company has to do a US GAAP reporting as well. So the reporting structure varies while the core of the calculations remain the same. So the principles are the same. So probably my first 1, 2, 3 steps are varying only very minutely between each of these accounting standards, whereas the last piece changes completely. Okay, now the most important part is what goes into the actuarial assumptions. Discount rate. Now the accounting standards is fairly prescriptive in this. It says you have to use risk-free GSEC rates. So what most actuaries do is we kind of take the 0 coupon yield on the date of valuation, which is either 31st March or December or September. And we look, what they say is you have to look for the duration in the yield curve that is matching to the duration of the liability. Okay, so we will show you a simple Excel to show how the duration is arrived at. And then probably I can give you a little explanation on how that happens. I don't want to change the flow here. There are standard websites like NSE or CCIL, that is Clearing Corporation of India, or FIMDA, which provides these daily yield curves. So these are publicly available informations. So you can even ask your actuary, if they can share the link, or you could go and Google it up and find out what is the yield curve. A lot of actuaries publish quarterly yield curve reports for chartered accountants to see, okay, because while 31st March happens on 31st March, we actually reached the reporting maybe in June, July. For auditors to have an idea, okay, am I expecting the liabilities to go up, go down? You start getting a sense of it once you have an assessment of what the yield curve means. So this is on the yield curve. So the discount rate is fairly less subjective, I will say. There could be an element of subjectivity here. So I am not saying it's a cast in stone thing, because in the accounting standards, they say this is how we recommend you to do it. Actuaries do take some element of judgment. I can give you a very simple practical example. Let us say 31st March, the interest rate spiked. Okay, and we are in, let us say, June, July, actually, doing the 31st March reporting. But by that time, the interest rates have come down drastically. Maybe that was a temporary spike. We have realized now it has come to more normal levels. Now, the actuary in discussion with the auditors can decide, okay, because this discount rate is long-term discount rate. It is not a one-day's discount rate. So we could come to an agreement saying, okay, the long-term discount rate looks like it is going to be stable at this place and not at that place. Let us take the lower level. Now that could be a judgment one could take if it is supported well enough by the movement in the interest rates. Other than that, it's fair. If in a stable interest rate environment, it's a very mathematical exercise. Salary escalation. What should salary escalation be like? Is essentially long-term salary increases that the company is expecting for its employees. Now, this is very specific to industry. Manufacturing industries have low, stable salary escalations, whereas IT and new booming startups could have very high salary escalations. This is something one has to go with what the company's industry is, what particular company's economic. See, I could be in IT industry, but I could be a very well-established company. So I may not be giving you very high salaries. I could be a startup in a manufacturing industry. So if I want to attract good staff, I need to give high salaries. So it could vary on the industry and the company and its economic business cycle it is in. Also, one to keep in mind is the long-term nature of this assumption. 1 year, you could always decide, okay, I'm losing a lot of staff. I need to pay very high to retain good staff, but that may not be what your long-term assumption is. So it is not a yearly spikes and falls. In fact, a very classic example that we have faced was during Corona period. There were companies which came and said, ma'am, is saal humne salary nahi di. Or we gave zero escalation. So can you project on zero escalation? Now, is that possible? No, I cannot assume next 30 years, this guy is going to get zero escalation, right? At the same time, his concern is very valid. Yes, the company is not able to see anything beyond 1 year or 2 years. So what we suggest in these situations is to take a staggered assumption. We say for year 1, take 0, no problem. Year 2, take maybe 5 or 8%, where you think you're slowly going to. And year 3 onwards, it will be probably your 10 or 12%, which might be where you long-term think like. So that gives the comfort to employer also that my current economic situation is addressed. And I'm not harping on saying, nahi, long-term lena hai, to long-term lena hai. I'm not going to look at the situation that you're not able to even pay the salary today. Right? So you could take what is called a staggered assumptions where you feel it is essential that the current situation. So we had a similar situation now in the 22 and now in fact in the coming 23, where company post-COVID are now having the surge in business. And people are leaving and going because they have many opportunities outside. So companies are having to give high salary hikes just to retain their staff. Now that they may be giving 15% and they're saying, no, I'm not expecting to give 15% the rest of my life. My average is over 8 to 10%. But because this year, everybody is booming and everybody is trying to attract good staff, I'm having to pay 15-20%. So you could have a staggered in the other direction as well. You can say in year 1, I will give 20% hike, but year 2, I might come to maybe 15-12%, and then I'll go to 8% in the long run. So staggered could be used to suit how the business situation is. The same applies to attrition. Attrition is again very, very specific to industry, the business cycle, the economic cycle in the market. And you could use staggered, you could use single long-term assumptions. The same logic applies between salary escalation and attrition. I'll come to what auditors or how they can. Yeah. Yeah. Absolutely, absolutely. So it's a very industry and the company specific. Yes, sir. Attrition rate means withdrawal rate or the rate at which people resign in your office. So these are terminologies used in the standard. So it could either be, you can call it a withdrawal rate or an attrition rate or a resignation rate. Now, what is the most important thing in assumption setting is consistency across years. So we don't want a situation where the company has been, let us say, historically for whatever reason taken, because let's say we have seen, and that's something we will show also. We've seen LIC valuations, that table comes, typically attrition is 3%, 1 to 3%. Now I have been taking, I'm a 10, 12-year-old company, I've been taking that statement only. Now today you have realized, you've had this session and you've now realized, no, they can't take whatever assumption they want, they have to take an assumption which is relevant to them. So you can't tomorrow go and tell them 2023 se aap 8% lena shuru kar do attrition. That may not be fair on the reporting purpose, because one, consistency has to be there and there has to be a smooth progression towards it. So you eventually think this company should have taken an attrition rate of 8%, let's say. That's your conclusion. But they have been taking only 3%. Don't move them to 8 overnight. Discuss this with the company and tell them, see, your industry, your company, you should be at 8%. But for some reason of ignorance, probably you've been at 3%. Can we, over the next 2 years, move to 8%? That's a more sensible thing to do, rather than just tell them, no, we have to move them. So these are things.
Then you assume you have to consider all those associated industry as taken for the entire policies.
Yeah.
Then maybe individually you may have different attrition rate, different increment rate or whatever.
Correct.
It does not fit into the rate of discount rate also which they consider.
Yeah.
What you have to accept.
Yeah. So I'll come to that. It's one of the top FAQs that we get, and that's something that it's very important for auditors to understand what is going in there and what is it that is required for this purpose. And there is a lot of confusion between these things. So thanks for bringing up this question, but just be patient for the next couple of slides. I'll explain that. Now, very quickly, there are 3 tables you need to be really careful about. As you know, the reports can run into 10, 12, 13 pages. 3 tables. One table is change in defined benefit obligations. So defined benefit obligation, or DBO, is the word used for liability. So this table shows the movement in liability. So I think as chartered accountants, you understand how a movement of a table looks like. So it starts from the opening balance, which is opening DBO, and you add whatever has changed. So the interest cost has happened, current service cost has happened, which means 1 more year of service he has put in. Any benefits could have been paid out for peoples. They could have made some contributions. Okay, and then you come up with the year-end liability, which is the DBO at the end of the year. And like all people who've done accountancy knows, the opening and closing, they will not tally. And we always have this one item called the balancing item. So if nothing tallies, you just put everything into the balancing item. So the balancing item, luckily for us, is what's called an actuarial gains and losses. Okay, now it is not as fictitious as I'm saying that just kuch nahi samajh mein aaya to usme dal do. Actuarial gains and losses essentially are a result of 2 main reasons. One is because what's called an experience adjustment. आपने पिछले साल assume किया कि salary escalation जो है सबको 8% हो जाएगा, but in reality सबको 8% तो नहीं होता है, किसी को 15% होगा, किसी को 8 होगा, किसी को 6 होगा, किसी को 0 होगा. At the company level, overall, you're expecting everybody's salary will increase by. So this year, when you've got the actual data, there is a difference between last year's projection for this year and this year's projection. So any experience change from what was assumed in the previous valuations to what has actually happened here will come under actuarial gains and losses arising due to experience adjustment. The other one is change in actuarial assumptions. See, we have said discount rate last year would have been based on the yield curve of last year. It was at 6.5. This year, yield curves have gone up. It will be at 7.5. The actuarial assumption has changed. The core liability hasn't. So that will come again under the actuarial gains and losses arising out of change in assumptions. So we have 2 change in assumptions. One could be financial, where all these discount rates will come. The other one is demographic, where attrition rates, mortality rate changes would come into that. So it is important for you to look at these actuarial gains and losses. The next most important table is fair value of assets. It's exactly the same thing as liability table, but it's on the asset side. So companies which don't fund their employee benefits, this table will be blank. For others, it's the same thing. It's the essentially coming out of actuaries don't do anything in this. The only thing they do is they take it from the LICs or their fund statement. So the opening fund statement, any contributions made during the year, any benefits paid out of the year, interest accrued during the year should give you the. So any balancing item would come under the actuarial gains and losses arising for this kind of thing. Service cost will not be, so that will come in the form of contribution that they have made in this year, how LIC would have determined that contribution to be made. Now here there is something called expected return on plan assets. Now this is not what you have earned in the fund. This is something that the accounting standard insists, saying that use last year's discount rate and give that expected. That is why we get the actuarial gains and losses. Otherwise fund statement सीधा सीधा देखेंगे तो actuarial gains and losses की जरूरत नहीं होनी चाहिए यहाँ, because from a reporting perspective the accounting standard requires us to estimate the interest expense in this. Hence any balancing out of the actual interest earned versus what we are expecting will come in the actual gains and losses of the plan assets. The third important table you need to look for is obviously the expense table. So you've got the liability and the assets. So you know what is the net liability to be provided. Now you need to know what is the expense for this year. So आपके पास typically how would it come? It is last year expenses minus this year expense. So last year's liability, difference in liability would cause the expense. आपने पिछले साल कुछ liability रखा, इस साल कुछ और liability आ गया, इसका difference आपके P&L में reflect होना चाहिए, right? So this is again, what does it cover? The current service cost, the interest cost, assets के तरफ से any interest income. Okay, actuarial gains and losses. Okay, you should always ask your actuary to explain these tables, saying कि see always these tables show 2 years, last year का भी इस year का भी. आप हमेशा देखें तो ये numbers बहुत ज़्यादा fluctuate नहीं करनी चाहिए. And if they do, you have to ask them why did it change so much? Maybe something has actually happened in the company that you need to know about. Okay, so it is important for you to ask them to explain the movement in these tables. And actuarial gains and losses is essentially, yes, yeah, it means it's an income. Because what has happened is that the liability has actually fallen from last year to this year. And a very typical reason why this could have happened, if nothing else changed, was the interest rates. Last year, if I discounted it at 6.5, and this year I'm going to discount it at 7.5. And we assume hypothetically nothing else changed. Number of employees didn't change, salary didn't change, nothing changed. You still will have a big difference, and that would be a negative expense. No, negative means it's kind of a notional income, like how you book a negative expense. This is again from a actuary's point of view. How do I see an AS15 different from an Ind AS? I'm sure chartered accountants understand it in more detail and intricately. So for the net interest, AS15 says take the expected. So this is a discretionary interest rate you can take in AS15. AS15 doesn't tell me how to take the interest on assets. It says, based on the expected return. करके छोड़ देते हैं, whereas the Ind AS is very specific. It has to be last year's discount rate. Actuarial gains and losses in AS15 goes into P&L. So pura change in liability goes into P&L in AS15. Whereas in Ind AS, actuarial gains and losses goes into OCI, and other things goes into P&L. Here again, Ind AS is specific कि जो post retirement के classification, 4 classification बताए थे कार्तिकेय ने. Short term, post retirement, long term and terminal benefits. Post retirement वाला सिर्फ OCI में जाना चाहिए. तो अगर आप लीव का वैल्यूएशन ले रहे हैं तो लीव का सब कुछ आपको P&L में निकालना है, उसमें OCI में नहीं जाएगा. Past service cost, AS15 actually differentiates, saying कि अगर vested है तो P&L में ले लो, non vested है तो आप amortize कर सकते हैं. because कई बार situation ऐसा होता है, कंपनी जो है 4-5 साल 10 साल की भी होती है और उसने कभी प्रोवाइड नहीं किया होता है, आज उठ के आके बोलते हैं यार अब करा दो, and the chances are you have 10-12 years of liability and the whole thing will hit your P&L in this year itself. So AS15 has a small provision which says non-vested benefits को आप over a period of time उसको amortize कर सकते हैं, whereas Ind AS says no, you have to take all the hit in the first year itself. Disclosure, AS15 is simpler compared to Ind AS. Ind AS asks for a lot more details like reconciliation tables. It asks for sensitivities. Okay, आप कहते हो assumptions इतने important हैं, but how do we know how sensitive is this account? Because nobody knows the right value of the assumptions. It's an estimate. Then how do we know? So for auditors or for the company CFOs to understand that this assumption is very sensitive. So if I'm moving it next year, I have to be careful about it. So Ind AS provides for sensitivity tables for each of the assumptions. Sorry? No. So there is a table which actually says liability. अगर आप जो discount rate है उससे plus minus 100 bips लेते तो क्या liability आती आपकी? Salary escalation अगर आप plus minus 100 लेते तो क्या liability आती? That is sensitivity. Now let's come back to what auditors should look for. Again, we will look at the 4 steps that we kind of saw. Data, like I told you, I have very little access to the data. अगर वो कहता है यही salary है, वही salary है. I have no way to know. And typically हमें problem कहाँ आती है मैं बताती हूँ. Companies out of lack of awareness. I'm not really saying that companies are all scrupulous and they want to cheat professionals. So say we are sitting in, let's say June, July, August, and then जो salary वहाँ पे जो staff है उसको बोल दिया जाता है actuary को data भेज दो अपना payroll से, अपना salary का data भेज दो, employee का data भेज दो. Now his latest data से किसी को भी क्या लगता है कि हमें latest data देना चाहिए professional. तो वो जून जुलाई में बैठा है, वो जून जुलाई का payroll आपको भेज देगा. Now for me, I will never know कि वो मार्च का payroll है कि जून का payroll है. The only people who have access to both pieces of information are auditors. So you have to see whether the data given is of people as if they were on 31st March. Is it the salary as on 31st March and not in June, July that we are sitting today? And a lot of times they have a lot of factory people, contract people, this people, that people, and I will never know whether full diya hai ki nahi diya hai. Correct. So you
So it will have double effect.
Yeah, so you have to be careful of what data is being provided to the actuary, and that check you will have to only make. Same as fund statements. अभी कई companies क्या करती हैं, एक से policy नहीं लेती है, 4-5 policy लेती हैं. LIC से भी ले लिया, SBI से भी ले लिया, या LIC के पास में ही वो को न्यू बिजनेस बढ़ाने के लिए क्या करते हैं, 4-5 पॉलिसी इशू कर देते हैं एक ही कंपनी को. तो sometimes what happens, the company is not aware. The employer is not aware. उसने 3 पॉलिसी का फंड स्टेटमेंट हमें दे दिया, हमें पता ही नहीं चलेगा कि चौथी एक पॉलिसी है जिसका फंड स्टेटमेंट उन्होंने ना LIC से मंगाया है ना हमें दिया है. It's very difficult for us to guess that. See, it's only it will happen if last year they have reported 4 policies and this year they didn't report. Then we will see consistency check and we will tell कि पिछले बार तो 4 पॉलिसी दी थी, आप एक ही नहीं दिया है. But as auditors, you have immediate access to whether. So these are things that you can check on the data front. On the assumption side, checking the appropriateness of the assumption. Employees कितने छोड़ के जा रहे हैं आपकी कंपनी में? Again, I have no access to it. Company says कि हमारा approximately 10% लोग छोड़ के जाते हैं. I just have to believe that. Whereas you have data of the last few years, and what we recommend as actuaries is that look at least for 3 years of data. See, 1 year of data is a little skewed because हर company का up down होता ही है. So look for 3 years. At the same time, I'm not saying look for 10 years because a lot of times in businesses today, 10 years becomes irrelevant. Okay, so look for 3 years of data, look for attrition, look for salary escalation, and see whether this number is sensible and close to that. Have an unbiased view. Please don't use, while as professionals, I also talk to the employers. While we say that we have this little discretion to come up with this assumption, one has to be clear, it has to be unbiased. Liability लेके आने के लिए मैडम थोड़ा कम करके दिखाइए, बढ़ जाएगा तो कम हो जाएगा, तो वैसे नहीं करने का. Because we know we have the access to fine tune it, should not be used to arrive at an answer. So always ensure when the assumptions are arrived at, and this is something that even the CFOs do. Ma'am, thoda is bar expense kam karwa do. We'll adjust the assumption. Now that's something, see, as an actuary, finally what the accounting standard says that the ownership of the assumption is with the employer. I am not the owner of the assumption. If the employer says 10% मेरी salary escalation है, मैं झगड़ा कर सकती हूँ, पूछ सकती हूँ क्यों है, कैसा है, but beyond the point, it's his ownership. Whereas the auditors have more access to that piece of information saying that no, but the last 3 years you've been giving only 6% salary escalation or 15% salary escalation. How are you claiming it as 10? Okay, so assumption setting is where I feel auditors can play a very proactive role. I've explained this. Always please ask for the movements in the liability. Try to see when you have last year table and this year table, look for 1-to-1. Last year interest cost 4 lakh रुपए था, इस साल 4.5 लाख हुआ है या 4.25 हुआ है. Sounds reasonable. Last year 4 lakh का interest cost था, इस साल जो 12 lakh दिख रहा है, doesn't make sense. Last year's current service cost was around 10 lakhs. This year it can't be 3 lakhs, 2 lakhs. Something is missing there. So ask questions. While you may not understand the calculations behind it, I think common sense a lot of time answers a lot of questions. And disclosures. This is again one place I would sincerely request auditors to because AS15 or Ind AS की reporting requirements बिल्कुल अलग हैं. But a lot of times actually का report आ गया 2 number दे दो, उसमें से liability का number दे दो, expense का number दे दो, खत्म हो गया. Please don't do it, because each piece of information that ICAI has put that needs to be disclosed has value in it. It conveys some message, it conveys some risk that we may not see it today. Like morning also say, जब तक पकड़े नहीं जाते किसी को पता नहीं चलता है. But ये सारा डेटा हमारे सामने होता है इन रिपोर्ट्स के अंदर. So please ensure, अगर Ind AS का रिपोर्ट आप मंगा रहे हैं तो Ind AS के सारे disclosures उसमें होने चाहिए. Well, a lot of time what happens is single format gets applicable for everything. And that's something that we tell when you see LIC का fund statement आप लेते हैं, बोलते हैं LIC से हमने valuation करा लिया. So we would try to show you some things that they don't meet these requirements. So you cannot just proxy anything for anything. Okay, this is one place where I think auditors and actuaries should work together. It is not, you're not questioning the actuaries. You're not saying कि क्या report गलत दिया, ऐसा नहीं कह रहे आप जानना चाहते हैं, because you are going to be reading these reports and making sense out of it. So you want to know more about it. So please do work with your actuaries together, ask them questions. It's a professional to professional discussion, and a lot of actuaries appreciate that, because they feel good when somebody else has read their report and says that, okay, something doesn't look sensible to me. Yep. Now I'll come very quickly to the FAQs we have encountered from our auditors repeatedly. It could cover a lot of questions that you guys have in your mind, but we can take more questions after this. So who should do actuarial certification? Obviously the person has to be an actuary. It is an independent actuary. So when LIC manages fund, there's one clause saying if you manage the assets, you can't manage the liabilities, because there is a conflict of interest there. So when anybody who manages the assets, you should not take certification from there. It has to be signed by an actuary. Like in you people, you write the membership number or something like that. It should be a physical person who actually signs it. So that's very important. This question also comes very clearly saying that, okay, I'm not 5-year-old. Should I do the liability valuation by matching principle, by accrual principle? Obviously, you have to do. I may not insist on the first year, because the company you don't even know will exist. But by the time it is 2-3-year-old, you know that the company is going to last. I think it's a good time for people to start getting into compliance. Why I'm saying this here in this forum is that a lot of these companies are small and they are good at the business they are in. So they rely heavily on what the auditors say. Because sometimes when we try to go to these small startups and say, okay, I think you should be doing this job, they say, why don't you talk to our auditors? Because we don't know this. We know our business. We don't know compliance. So a lot of times it's the responsibilities on the professional to advise them. And correctly so, if AS15 has so much of non-compliance, that's something that is purely due to non-awareness among professionals, that this is a requirement to be met. If LIC's gratuity policy is taken, no need for an actuarial valuation. Just pause this question. I will show you something as a proof, so that it's not something that I'm just stating. Another point here to add is LIC is managing the assets. If you remember, I told you there are 3 tables to look for. One is the liability table, one is the assets table, and one is the expense table. LIC is managing the assets table. Now, it is nice to believe assets and liabilities should be equal. They should be equal. but they won't be equal. In reality life, they will never be equal. You have to independently assess the liability and the assets and hope that they match. And wherever the difference is, where you adjust the contributions next year, the benefits next year, right? To believe that, oh, I have collected the asset statement from LIC and I'm going to make liabilities equal to assets is wrong. It's outright wrong. Okay. There is also a non-compliance thing that I will show you in an LIC statement where they explicitly state that our statement is only for the sake of contribution and is not a substitute for AS15 or actuarial valuation. Okay, a lot of times that gets ignored. Okay, can't I do ad hoc calculations? Kartikeya has insisted. It is a compliance thing. So one should comply. Ad hoc calculation is not a substitute for getting a professional to do a proper due diligence and do the calculations for you. The company has never made a provision. Now, how do I deal with it now? The company is already 10, 12 years. No problem. Get them to get the data. And what we will do is we'll calculate the past service liability, which is, let's say, last 10 years, whatever liability. We'll book them all based on whether it is an AS15 or an Ind AS company. We will decide whether to book them all in the P&L this year or amortize it. And then going forward, it will be just a 1-year roll-on. Okay, so the first year the company will have to take a hit, and that's how you kind of clean up the book for once, and then you kind of only bothered about 1 year's more of. Okay, why doesn't the LIC's funding valuation and AS15 valuation match? Now this is a big question. They saying, Madam, हमने LIC से भी valuation कराया था, आपका number और उनका number match नहीं कर रहा. It will definitely not match. Two things. One, they are giving it from an asset perspective. कि आपको contribution कितना देना है, उसके हिसाब से वो valuation कर रहे हैं. उनके सारे assumptions उनके हिसाब से हैं, not as per your requirement. They are not bound to set assumptions or discount rates as per what the accounting standard says. Ki take the zero coupon yield curve, match it with the duration. It doesn't need to do anything. It just sees उनका fund कितना कमा रहा है हर साल. उसके basis पे वो discount rate typically 7%, 7.5% लेते हैं. Now, another thing with respect to LIC's statement is a volume there. There is no way for LIC's volume, it can actually do a customized report. They just have a generic report which will help you to get an idea कि कितना contribution देना चाहिए आप, ताकि आपका fund grow करता रहे. It is not a substitute for what we are looking at here. Okay, so that is why these two valuations are done for two different purposes, with two different set of assumptions, so they will never ever match. Okay, how is the future expected duration? I'll just show you an Excel for this. How do you deal with left employees but benefits are not yet paid? Now, what typically happens is that March में या February में employee छोड़ के जाता है, full and final settlement हुआ नहीं होता. Okay, so while मैं employer से मांगती हूँ कि आप 31st March का मुझे employee data दे दो, ये employees है नहीं उसमें, but इनकी payment हुई नहीं है. So for these people, you have to ask them to give a separate set of information. हम लोग accrued gratuity actual on a payment basis निकाल के on top हम liability में इसको add करके देते. And this is again one place where auditors play a role, because ये तो data हमारे scanner में आता भी नहीं. And there could be many more questions which we can take the questions later. I will just show you two Excel. No, one Excel and one LIC statement. Is it in the recon table?
Yes.
Yeah, it's this one. Yeah. So if you can, yeah. Okay. So if you see this table, table 2, present value of obligation at the beginning of here, it's very similar to the table we have seen. DBO का जो table के जैसा ही ये table है, उसके नीचे fair value of plan assets का table है. ठीक है, तो ये लोग मान के चलते हैं कि ये तो हमारा actuarial valuation हो गया. But just read this. And इसके सारे जो disclosures आपको बड़े similar लगेंगे. अब यहाँ पढ़िए. Last note. This is not a certification under AS 15 revised. Okay, it's a simply report generated to help the companies for proper accounting of employee and liabilities. Now, this is a very, very important statement. And I know even very, very large companies just follow LIC का है statement, चलो आगे बढ़ो. अलग से कराने की जरूरत नहीं, one more job, why to get it done? It's not about, compliance is not about more work. It's about to have the right checks and balances. Okay, so this is something which is very important for you to see. One last. Now, what is expected future duration? Now, what happens typically is, अब समझिए मैं I am 40, let's assume. I'm 40 and my retirement age is 60. So what typically anybody will say, okay, 20 years is your expected future. Now that is true if there is no other attrition issue. If there is no chance from an employer's perspective, no chance of me to leave and go, resign and go, then yes, the future expected is close to. So if you see this yellow cell, it gives 19.31 instead of 20 years. The reason is there is a probability that I could die in this 20 years. That's why it's not exact 20, but it's close to 20. But the reality is I could also resign. There is a high probability any employer, see, no employees these days look for beyond 5 years. So even if I assume, let's say 10% of attrition rate, look at that number. It's gone to 7.7, which means I'm expecting this 40-year-old employee in a company environment which has only 10% attrition rate to last only for 7 years. So do you see discounting में कितना फर्क हो जाता है? 20 साल का discounting की जगह मुझे 7 साल की discounting करनी है, तो attrition rate कितना important हो जाता है? And I am not taking exorbitant 50% attrition and all. 50% लूंगी तो duration will become अगले साल छोड़ के चला जाएगा. But there are companies who have 50% attritions. Let's be fair. There are some industries where, you know, almost 2 या 3 साल में पूरा staff turnover हो जाता है. In that case, if we are taking an estimate for 20 years, 30 years, that doesn't make sense. So we are grossly underestimating the liability by doing that. So hence the importance of, you know, the attrition in even arriving at the discount rate. Attrition अपने आप में जरूरी है, क्योंकि वो cash flow में जा रहा है. But even to arrive at the discount rate, आप 7 साल का yield curve में rate देखिए और 20 साल का rate देखिए, obviously they won't be the same. So I'm going to take a completely different discount rate to discount my cash flows. Right? So that was me essentially. I'll kind of hand it over to Karthikeya. He'll kind of cover the balance of session. Yeah. I think that is why I said. Yeah, I think that's where I said the assumption setting and all is a very powerful tool in professionals' hands. And you have to have an unbiased view on this. You have the power to get the right answer or manipulate the answer as well. I mean, that's true for any audit work. I guess that's why, you know, so much of responsibility is put on this profession.
So how do you
is paying the salary as well as? Okay. So as long as the salary or the bonuses is paid on the year-to-year basis, then there is no need for actuarial valuation in it. It's just taken as an expense in the books. It's only if there are these days schemes which come, which says, okay, I will pay you if you last with me for 3 years or 5 years. So if I pay you in 5 years time, then I have to accrue and I may need some calculations for that. Yeah. Yes. Yeah, correct. Okay, we'll take all questions together. We'll let Karthikeya continue with the presentation. Yeah, thank you.
So the show is not over yet. It is still, we have reached the halfway only. So as we have discussed about the regulations, etc. Let me just quickly touch on some points from the taxation aspect, because regulation we have seen, we have 10 employees requirement, etc. Accounting standard says we need to do actuarial valuation. If we go to the taxation, because as a chartered accountants, we need to aware about the taxation as well. So under the section 36(1)(5), it says that if we make any contribution to the approved gratuity fund, it is allowed under the income tax as an expense. The point to note over here is it has to be an approved gratuity fund. So let's say ABC Limited, they directly purchase the insurance policy from the LIC or SBL, because I'm not against LIC. Wherever we are speaking LIC, it means insurance company. It's like Colgate and Manjan. So that's how we are not attacking the LIC. It is just synonymous to the insurance company. Okay. So if you are purchasing the policy of any insurance company under the group gratuity directly, that will not qualify for the 36(1)(5). 36(1)(5) says it has to be approved gratuity fund. For approval, you need to apply to the CIT for the approval. So that's where the role of chartered accountants will come, that we will cover in detail as well. So as a tax auditor, you need to ensure if there is any contribution, it has to be approved gratuity fund rather than a direct policy. Direct policy will be simple investment like mutual fund investment, etc. The next thing is, which is not aware to many of us, that you cannot have the irregular contributions. There is a limit being given under the income tax rules 103 and 104 of the income tax rules 1962, which says that in a year you can contribute only up to 8.33% of your salary. So you can't say कि 4 साल कुछ contribute नहीं किया, अगले साल liquidity आ गया, wholesale में contribute कर दो, and we take full exemption under the expense. It cannot work that way. In a year, you can contribute only up to 8.33%. If you take more deduction, it is wrong. पकड़े जाओगे, तभी question आएगा. It's like what we discussed in the morning. It's a self-assessment word. So whenever AO picks up, then there will be penalties. Next one is on the auditing part. SA 620 says that for the using the work of the actuary, and also we have seen that there are various irregularities being found by the Financial Reporting Review Board of the ICI, that so we need to ensure that these compliances are being done. So in nutshell, wherever company have more than 10 employees, we need to get this valuation done. If we talk about the leave, ये कंपनी को लेना है. कई बार क्या होता है, प्रैक्टिस में हमने देखा है कि जब भी आप ट्रस्ट बनाते हो तो LIC आपके बिहाफ पे एक कागज IT को जमा करा देता है, बट दैट डजंट मीन कि आपको अप्रूवल आ गया. जवाबदेही कंपनी की है कि अप्रूवल आना चाहिए. LIC वो मान लो एक तरीके का आपका मीडिएटर हो गया कि कागज कौन जाके जमा करा के आ रहा है. Responsibility lies on the company management directors, that it is our responsibility that it is a approved fund. Assessee has to do. Yes, yes. I have seen many large companies, listed companies, 1,000 crore assets in the insurance policy. They don't have any